Good morning. Today is Wednesday, September 23rd, 2020, and thank you for joining us for another edition of the Market Commentators Podcast. My name is Andy Wilms, President and CEO of Milwaukee Company, and joining me this morning, as usual, is my cousin Mike, who is the Milwaukee Company's Chief Operating and Compliance Officer. Good morning to you, Mike.
Good morning, Andy. Good morning, everyone.
Before we get rolling here, a quick reminder that nothing in this podcast should be considered to be investment advice, and the views expressed represent Mike and my personal views and not necessarily those of the Milwaukee Company. And that being said, let's get started. And typically, we begin with a recap of what's happened in the markets since the last time we spoke. And so last week, the S&P had an interesting week. It rallied more than 1% on Monday, and those advances were led by the tech sector, which rose by about 2% on Monday and 1% on Tuesday. But then those earlier gains were quickly undone as tech reversed itself on Wednesday, Thursday, and Friday. At the end of the week last week, large cap stocks were down about 1%, while U.S. small cap stocks actually rose about 2.5%. So we're seeing some of that rotation, where people are getting a little concerned about the valuations in large cap and are starting to think that the lower valuations of small cap is starting to look a little more attractive. Overseas markets fared a little better last week with somewhat less volatility, with international markets of developed companies finishing up about 0.5%, and emerging markets were up about 1.5%, which goes to show the power of diversification and the need to invest both domestically and internationally. Monday, the Dow Jones Industrial Average and the S&P dropped 1.8% and 1.2% respectively amid concerns about a possible new shutdown brought on by this wave of coronavirus cases, but the Nasdaq, was about flat on Monday, which I thought was interesting because it was all again driven by the late session surge in these big tech names, and the big tech names pitched in again yesterday, helping the S&P snap a 4-day losing streak, which was its longest losing streak since February. So, kind of more of the same, it seems to me, Mike, with big tech, everything going depending on how big tech does in terms of the S&P. But we have seen a greater interest in some of the mid cap, small cap names and some of the other sectors of the S&P 500. What's your take on what's been happening recently?
Well, I mean, I think, it's an interesting observation you're making about small cap and starting to see a little bit better performance there, because that's normally an indication on expectations for improvement in the economy. Yep. Small cap performs when the economy is growing, and it'll be interesting here. I think at the end of the week we get the first estimate. I guess no, that's next week where we get the first estimate on third quarter GDP growth.
Right. Yep. I'll get to that in just a minute. But before we start talking about GDP, COVID still seems to be actually is becoming more relevant, I guess, or more impactful on market performance as of late. Why don't you give us a rundown of where we stand there?
Well, I guess this is a statistic that I wish I wasn't reporting, but we broke through 200,000 COVID-related deaths yesterday here in the United States. There's been a lot of media coverage that it's the highest number of deaths in any single country in the world. I would point out that we are 11th in terms of mortality rate per 100,000. There are a number of other developed countries, the UK, Spain, Brazil, that have higher death rates per 100,000. On the good news front, Johnson & Johnson announced this morning that they were launching their vaccine candidate into a large stage 3 clinical trial, and a much larger trial, 60,000 patients. versus the other larger trials were 30 or 44,000.
Right.
And even though they're launching their stage 3 clinical trial 2 months after some of the other trials, the good news is that the Johnson & Johnson trial is for a single shot. The other previous 3 trials require a first and then a follow-up vaccination shot. So,
big improvement.
Well, and the other thing is the Johnson & Johnson vaccine candidate itself doesn't require ultra cold transportation. It's ambient temperature, so it doesn't require special handling.
Yeah, so it's much easier to distribute. And I noticed there's been a lot of talk about the COVID situation in Europe getting worse, especially in Britain.
In the UK, correct.
UK. Are you familiar with any of that? Or?
Well, Boris Johnson announced yesterday that he recommended everyone work from home if at all possible. They're reinstituting social gathering limitations on pubs and restaurants, for instance. There's a potential of them re-implementing these additional measures for up to 6 months. So, I mean, there's a real concern in a lot of this, to your point with what's happening in Europe and elsewhere in the world. Our hemisphere, the Northern Hemisphere, is now going into the cold weather period. Exactly. And the start of the traditional flu season.
Right.
And so, there's a fear that there'll be a second wave. I mean, Scott Gottlieb, the former head of the FDA, was advising that there's a real potential for a second wave worldwide here with temperature change.
And we haven't even gotten through the first wave yet. It doesn't seem.
Well, and that's one of the things. I mean, in prepping for the call this morning, I did take a look at new cases and deaths here in the U.S. and both numbers are down dramatically. I mean, and I almost am reluctant to share the fact that death rates had been below 500 for the last several days.
Yeah, which is fabulous. Although here in Wisconsin, we've seen the number of cases really rally, and we've been hitting all-time highs, I believe, in new cases. Now, it's hard to say if that's because more people are getting infected or because we're doing so much more testing, especially with people going back to school. The amount of testing has really skyrocketed. But it's a very serious situation, obviously, and continues to be so. There is some good news. I did notice that, there was an interesting statistic that came out of the Brown University School of Public Health. And they pointed out that roughly 30 to 50% less likely to die from coronavirus today than they were in the early spring. So that is absolutely fabulous news, I think.
That is a kudos to the healthcare industry and the medical professionals having identified the best way to treat someone with a serious case and when to provide different types of therapy, the further distribution of the remdesivir, which is the Gilead antiviral therapy, and the better use of ventilators and other types of treatment for people with a severe case that have been hospitalized.
Yep, we've made great progress on that front, but the economy, well, it's hard to say if we've made as much progress because there's positives and negatives there. Jobless claims rose slightly last week, but they remained under 1 million for the third consecutive week. However, initial claims are still 4 times as high as they were prior to the pandemic. And consumer spending appeared to slow in August as the extended unemployment benefits dropped out for millions of Americans. And the Bureau of Economic Analysis, as you mentioned, will be issuing its third quarter report on October 29th. But the advanced forecasts of several different sources suggest that we're going to see a surge in GDP, but the surge will be off a very low level. So there's lies according to the Atlanta Fed GDP Now model. They're expecting about a 32% increase in GDP. The New York Fed's Nowcast model is suggesting about a 14.3% increase in GDP. So huge differences, but both very positive. The question is going to become, to what extent we have some lingering economic effects from this coronavirus, even after we have a vaccine, and even after we have, more effective treatments. And that's just time will tell. I'm not convinced that the issuance of a vaccine will, get the economy running full bore once again. I think there's a potential that things could take a while. And I thought it was really interesting, and I'd like to hear what you said. I think about this, Mike. I saw on Monday that St. Louis Fed Reserve President James Bullard said the U.S. economy has enough momentum to continue its own recovery from the coronavirus slump, even if Congress fails to pass additional support. I tend to agree with him, but his views are in direct contrast to those of Fed Chairman Jerome Powell, who has continued to urge fiscal aid and sometimes put the message in dire terms. He's saying, sky is falling kind of thing.
Exactly.
Where do you fall?
It's kind of interesting that you're linking Chairman Powell's view to James Bullard's, because they both are working from the same database.
Right, exactly.
And you and I had a conversation about how minimally the various stimulus programs that the Fed implemented back in March and April have actually been used. I mean, where they had forecast or provided a facility of up to $300 billion for financial support for state and local governments, only one is borrowed, the state of Illinois. That's only for $1.8 million or $1.8 billion, excuse me. And I mean, the Fed has got a huge amount of ammunition to provide additional support, looking for fiscal support from the government. The big difference is that puts the money in the hands of the consumer. And going back to your observation about the drop in consumer spending in August, I think there's some validity there. But by the same token, if you look at housing sales and the lack of housing supply and car sales, there's a real question mark about whether there's a need for additional stimulus. I mean, with what the Fed is doing with purchasing treasuries and mortgage-backed securities, they're forcing longer-term interest rates lower. And I mean, if you can actually refinance your 30-year fixed mortgage for 2.5%, that's just truly amazing.
Yeah, and it's interesting because the market seems to be concerned about whether or not there's going to be more stimulus. I mean, if we look at the market after setting an all-time high of like 3,588 somewhere in there on September 2nd, the S&P 500 index has closed lower every week this month, so far this month. So we are experiencing a sell-off. And from the way I look at it, there are, basically, four principal causes to what's triggering that sell-off. It's the deadlock in Congress on a fifth stimulus package, because that's what we would be up to. It's concern about the increased concentration and high valuations in these so-called FANG stocks, that have been driving the S&P and the NASDAQ higher. It's the resurgence of the COVID-19 epidemic and the possibility of another lockdown that people have been worried about. Even though the numbers are, as you point out, lower on a national level, there is signs that it's getting worse and could potentially get much worse in the winter. And we have these looming elections. So you put those four things down, it seems that those are all sort of driving the market lower, and not unsurprised. It's not a surprise to me that that's the case. What's your take, Mike?
Well, if you lump those four factors together, I think the word that would come to mind is uncertainty. And
yeah, at least.
The market just doesn't like uncertainty, and there's a lot of it. And I mean, you could work backwards from the election, and we could finish up the podcast just talking about all of the different polls and the uncertainty around what the outcomes are actually going to be. And I think, a fifth factor that's just going to make this a little bit more politicized is the potential for nominating a Supreme Court justice also.
All right. Well, putting politics aside for a second, in terms of what you would like to see come from a political standpoint, just from an investor standpoint, tell me what how important is the outcome of this election? Is it something that people really need to be hedging against? Do you think it's something you really need to be concerned about as an investor and planning for, in terms of how you manage your investments?
Well, we've had the internal conversation about the fact that the level of hedging post-election is the highest ever.
Right.
And if you go back and you look at closely contested elections, going back to World War II, I think there's been 7 or 8, and historically, based on the fact that there had been a high level of hedging against the election outcome, there's been a short-term blip up once the election has passed. Mm-hmm. But we're in the exact time frame now where everybody is starting to put their hedges on 6 to 7 weeks before the election.
Right.
And that's going to have a lot to do with some of the volatility that we're seeing. If history is any indication on what to expect in the current time frame.
Yeah, and historically, elections really have had little impact on how the stock market performs over the longer term.
Exactly.
So if you're a short-term market timing kind of guy, if that's how you play, you play the market, which I hate to even use, because you shouldn't play the market. It's not a playground. Wall Street's not a playground. You've heard me say that before. But the fact of the matter is, if you're a longer-term investor, trying to alter your portfolio based on your concerns about what might happen in the election doesn't make as much sense to me, because there's so many other huge factors at force. You got all the money the Federal Reserve is pumping into the economy. You got strong housing demand. You got corporate profits rising from depressed levels. You got investors willing to pay up for these growing secular stocks. I mean, it seems to me it's unlikely that the election is going to make or break the cycle that the market's in right now. Now, one thing that could change this would be if the Senate and the White House are both controlled by Democrats, which, by the way, the last time I checked, the market was pricing in 53% of odds in favor of the Democrats sweeping both the White House and the Congress. So if that were to happen, then I think, we've run the potential of a more significant impact. But since there's really little way to predict that, I think it's probably not the outcome of the election should not be a major factor in in a long-term investor's decision-making process.
I would agree with that, but I think what the hedging around the potential election outcome is exactly focused on that 53% probability of a Democratic sweep, and the fear is that there would be some type of tax proposal that would flow through Congress and be signed by a new president, Biden.
Right.
And there's, a number of different tax discussions. Biden's tax plan has been released. It calls for a wealth tax, a change in 401k. I mean, just a lot of noise for investors to be thinking about.
But even if you get a Democratic sweep, that doesn't mean these things are going to get adopted, right? Because
I agree.
The filibuster, you've got some conservative. I still think there's a few of those blue dog Democrats floating around that might, they're not the bloc or constituency they once were, but they're still out there and be heard. So, if you're concerned about how the election might affect the stock market in the next for 6 months after the election, where you could see, like you said, I think some real problems over that shorter time frame, then, and you're willing to pay up for some insurance, to guard against that, I think it's a great idea. It could be a very good idea. If you're trying to bet on which way the election is going to come out, then, if you want to do that instead of bet on the Packer game, all more power to you. So anyway, all right. Well, enough about politics. Well, I guess this is a political question too, and as a attorney, it becomes of interest. It was of interest to me in particular, and that is the passing of Justice Ruth Bader Ginsburg, which has set the stage for a political battle of epic proportions. This one's gonna really be something. Democrats are strongly opposed to the selection of a new justice ahead of the November election, but we'll need the support of 4 Republican senators to stop the process, and it doesn't seem like they're going to get there. So there have been talk of all kinds of really dramatic measures, even some have suggested impeaching President Trump to prevent the process from going forward. But the question I have as an investor is not so much about whether they should or should not be doing this and all that sort of thing. The question is wondering whether or not this fight will affect the markets, and if at all. And to me, the biggest impact might be the fact that it makes it almost very, very little chance of getting a second stimulus or a 5th stimulus package adopted before the elections. And so that pushes it out further, and that could cause and has seemed to cause some concerns amongst investors, and has taken a toll a bit in the markets the last week or two. I guess I would say. What's your feeling?
Well, first of all, I think there's a positive signal in the fact that the House and the White House have agreed on a spending bill here, a continuing resolution to fund the government through December 11th. Right. So there's some level of civility and partisanship and working together to do what's right. I think there's some huge political risks on both sides of trying to put forth and vote on a Supreme Court justice nominee before the election. Yeah,
and so you think it will occur, and that won't be a problem for the markets?
Well, I don't know. My crystal ball is very cloudy in this particular. I think President Trump, he's clearly stated he'll make a nomination by Saturday.
Right.
And to your point about needing 4 senators to break from the party, Mitt Romney has said that he would vote for a nominee. What that means exactly, I can't even tell you what that means. Right. He'd respond.
It's very uncertain at this point, and that's, as you said earlier, the market hates uncertainty. So it does represent a potential threat to the market in the short term. it seems to me, because I think this is going to be a drag down, ugly fight. Everybody's switching sides. Everybody's being hypocritical. The Republicans who said you shouldn't, when Obama was president, the Republicans who said you shouldn't vote, let the people decide. Last time around, and now saying, well, we're going to go ahead and vote for it. And the Democrats who are saying you should vote now, there's no reason to wait, are saying, well, you should wait now. You should wait now because you say. And so there's hypocrisy on both sides of the equation.
Exactly.
My big concern is it will get ugly, and that could be a problem for the markets, at least in the short term.
Well, and when you look at the handful of down days that we've had here, they've been tied mainly to developments with the virus and the fact that Congress can't seem to agree on the fifth stimulus plan. And I think that it's you don't want to underestimate the impact on the market of not actually passing a bill. Whether it's to provide the $1,200 again, to come up with some kind of reformatted unemployment insurance at the federal level, the Paycheck Protection Program, and you can kind of go through the list of industries on the permanent layoffs that are being announced here. The airlines were in Washington advocating for additional support yesterday. There's a number of other industries where you've seen major layoffs. I mean, the only bright spot is e-commerce and the number of new employees that Walmart, Amazon, the usual suspects in internet delivery. Are the number of people that they're needing to hire.
All right. Well, we have about I'd say a minute or two more. If you want, we could touch base real quickly on this TikTok global sale issue. I guess I would just say, this whole thing just seems to indicate, that the state of U.S.-China relations have really taken a turn for the worse, and that's a big concern of mine. If you look at the rhetoric that's surrounded this whole thing, the things that the leaders and politicians on both sides are saying is quite harmful to the constructive relationship between those two countries. And I think this is one thing the market might not be given, the potential breakdown of U.S.-China relations is something that the market may not be fully appreciating how important that would be to the global economic system, and something that I would tell our viewers to keep in mind as they make investment decisions, because this relationship, if it gets much worse, could be a big problem.
Well, and I think that your global economic observation is really the key, because the China relationship has had so much to do with globalization and everyone's supply chain and accessing the cheapest labor pools in the world. So there is a real risk if globalization breaks down and supply chains revert back to higher wage environments. Prices necessarily will need to go up for companies to maintain their margins. So either prices go up and margins are maintained, or prices go down and earnings go down, and that'll obviously have a negative impact on the market also.
All right. Well, that's very well said, Mike. I agree entirely. And on that happy note, where we ended up agreeing, I think that's a good point for us to wrap up our conversation today. Unless there's something else you wanted to bring up, I will say thank you all for joining us. Please keep in mind that you should not act on any of the advice you heard in this podcast until you have discussed it with a financial professional who is familiar with your personal situation and your investment objectives. Okay, thank you, Mike. I appreciate your participation, and thank you, audience. We're glad you joined us, and all of you have a great day.
Have a great day, everyone.
Bye now.
Thanks.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.